Hello, fellow investors, and welcome to another episode of Ritter On Real Estate, where we teach you how to passively invest like a pro. Today, my guest is Matt Hansen. Matt is the founder of Hansen Holdings. He is a former corporate executive who's transitioned into real estate and has a portfolio of over 2,000 units throughout Texas, Tennessee, and Florida. So, Matt, thanks for coming on the show today. Really excited to learn from you.
My pleasure, Kent. Glad to be here.
Yeah, fantastic. Well, before we dig in, I want to start at the top like we always do. Tell us a little bit more about who you are and how you got to be where you are today.
Oh, thanks. So I retired a couple years ago as a global director in a Fortune 100 company, which prepared me really well for syndications in large multifamily deals, because that's really what it is. It's just a business.
Mhm.
So while I was working, I did do some deals. I started passively investing first, and then eventually I started becoming a GP and deals and running deals end to end. That's kind of how I got into it. It's really good to see the passive end first before you become a general partner, so you know what it's like to be a passive investor. So I think that was a great experience before I got into it. And then since then, we've just been doing tons of deals at partners in different areas of the country, like we said, Texas, Florida, and I've got a friend doing deals in Arizona that I'll be partnering with him so we can diversify our investors' portfolio. But that's kind of how I got started. About 6 years ago, I got into it, and now it's my full-time gig and having a blast.
That's great. Sounds like it's you retired, but you didn't really retire. You just started a second career, but you're probably having a whole lot more fun now, I imagine.
Yes, absolutely.
So I thought it would be really your perspective coming from having been a passive investor to then transitioning into the world of syndicating your own deals and being a general partner. I thought you would have great perspective to kind of take a step back and get into some basics on that we haven't gone over on this show in a while of just around what does it mean to passively invest and how do you and how do you make good investment decisions? How do you find a sponsor? Um, and how do you actually go through the process so that our listeners can be confident as they go out and look for investments and look to maybe make their first investment right into real estate and follow the playbook that so many have to financial freedom through real estate. So I want to run through that with you today. And I thought the best place to start would be is you talked about being a passive investor. That probably means a lot of different things to a lot of people. So to you, what does being a passive investor mean?
Being a passive investor, particularly in a real estate syndication, or it's kind of like a crowdfunding, is that you literally write a check and sign some paperwork and you're done. There's nothing more you need to do. There's no action. You hear about all these get rich quick schemes online of passive investing. This truly is passive. You don't do anything else other than once a month, you'll get our investor update on what's going on with the properties. Read through that, make sure everything's going fine. That's really it. It's truly passive investing. Now, and I understand that not everyone has 50, 75, or 100,000. Those are typically our minimum investments. But when you're at that level, this is the best thing to do because it's tax advantage, recession resistant, a hedge against inflation, all those wonderful things out there. And it's really no work. The only thing, and we're going to get into this, is education. Before you write a check for any deal or anything you invest in, you need to do your research. Watch Ritter on Real Estate. Learn from other people that have done it. Learn from their mistakes. So that's the key thing, is that educate, educate, educate. That's probably the three most important things before you passively invest. But you can do it in real estate. It's one of the few things that truly is passive investing,
Mhm.
passive income, because you really don't do any work other than vet the deal. And we can get into that a little bit later as well.
Yeah, but that's an important point because I think when a lot of people think about real estate investing, they think about I'm going to become a landlord, right? I'm going to buy myself a second job is how I look at it, right? You're going to buy a single family home versus most people don't realize that they can own a piece of 100, 200, 300 unit apartment building, right? A much more sustainable, substantial and kind of steady business, right? And
Exactly.
so I think it's important for people to understand. You come into it, as you said, passively. Now, there's some trade-offs when you're a passive investor, right? Because like you said, you sit it and forget it. You're right. You do your work is really done up front, right? Like you said, educate yourself, make that decision, write the check, and then you don't have a lot that you have to do. The trade-off is, or maybe, well, what are some of the trade-offs then
That's
that
a
you
good
would
point.
see?
If you're a control freak, and there's people I've said, no, this is not a good fit for you. If you want to have control over the deal, and so that's one. Okay, you got to be able to trust the people you're investing with, so you don't feel like, okay, I've got to be worrying, got to check their paperwork and all this stuff, their accounting and things like that. That's not a good fit for you. Then go ahead and actively manage your own real estate. The other
Mhm.
one is your money is tied up for up to 6 years. Now, most of our deals have been turning in 2 and 3 years right now, but we always say, hey, the business plan is 6 years. Plan on having your money illiquid for 6 years. I think those are probably the two biggest things that I see. It's tax advantage, it's really low work. So if you're comfortable in locking your money up for extended period of time, knowing that it's not liquid and that you're okay in giving away control, and that's what it is. So you've really got to vet your sponsor. So I think those are the two biggest downsides I see that potentially individuals say, well, I don't want to do that. I want to be able to have my money liquid because I have a kid that's got to go to college in 2 years,
Mhm.
or I want to have control over it. And if you're not, that's
Mhm.
not a good fit for you. Don't passively invest in real estate because you don't. You're going to trust an asset manager and a property manager to manage your investment for you. So that's why it's so critical to vet them well. Is there any that I missed? Like, can you think of, Kat,
No,
that
you know what? Those
are there?
those are the 2 big ones that I had. So you hit on both of them, actually. I think those are things that are really important for people to understand. I think control is the biggest one, right? I mean, I think a lot of people that have reached a level of success to be able to passively invest in deals uh, are used to a certain level of control. You're probably running a business or a pretty substantial part of a business, or a practice or firm, something, right? So that idea of giving up control can be difficult for people. But I think as you outlined it, right, you're doing that because you're gaining. Well, one, you're actually gaining the freedom because you don't have to do anything. Two, it allows you to diversify more, right? Because you can invest your money across a lot of different sponsors, different geographies. Um, there's pros and cons with everything. But yeah, no, I think you hit the two ones right on the head. So taking it down the path a little bit. So okay, we understand what passive investing is. We understand there's pros and cons to it, right? Everybody needs to make their own decision. Um, what's the first step? So say you say, okay, I understand it. I'm comfortable. I want to be a passive investor. Where do you start?
That's what's tricky about this because Wall Street doesn't want you to know you can passively invest in real estate, like these large apartment complexes. So there's nobody out there with billion-dollar advertisement budgets like Fidelity and Vanguard and all those big guys out there. So it's really, you need to know somebody like Kent or I that it's doing deals, and then you get to know them and vet them. So it's really challenging. And that's why I think it's so great what you're doing and what we're talking about here is that you have opportunities outside of Wall Street because I was the schmuck 33 years ago that put all of his money in the 401k because that's what I was told to do.
Hmm.
And then when I got to being 40 in my late 40s, like, hold it. I don't have access. I wish I could retire right now, but I can't. I don't have access to that money without paying. I'm in the highest tax bracket. Plus, I got to pay a 10% penalty to get that money
Right.
out.
Right.
So that's just like unless you are in the know that, oh, this even exists. So that's the first step is, if you're listening to this podcast, now you're in the know. Now you just need to decide, okay, Kent's a great person to invest with. Um, is just really vet the sponsor. So I think that's the number one thing is once you've discovered it, then the gates open. Now it's
Yeah.
just a matter of selecting, okay, which areas do I want to invest in? Which states do I want to invest in? And then who do I want to invest with, which is almost more important than the deal itself. Because a good general partner deal runner can make a mediocre deal really great, but a bad deal runner can make a good deal hit the ground. I mean, just
Yeah.
it's not. And I experienced that in one of my early investments that I didn't do a really good job vetting the general partners and there was
Yeah.
a capital call on it, which means, okay, I'd put 100,000 into it. It was probably a year later. I said, oh, you know what? We're having problems. We need more cash influx. So everybody needs to put in, that example, I think wanted 12,000 more money, 12,000 more dollars. And I said, no, I'm not going to put it. So what they did is they diluted my shares. So instead of having, 100 shares, because the shares $1,000 typically, they diluted my shares. So I lost
Yeah.
12 shares basically. But I wasn't going to throw any more money at that deal. So
Right.
that's an example of, okay, it was early. It's like one of my first investments. So there was three partners. The one partner that I knew, like, and trusted, after about 6 months said, I'm done with multifamily. I'm going to go off and do something else. That left the other two partners, which were not real seasoned individuals, but they were like, I think they were both CPAs or whatever, but they didn't know what they were doing. And within 6 months, they'd run it to the ground because they weren't keeping an eye on the property manager and things like that. So, I
Yeah.
mean, that was an example where I made a mistake. I didn't vet all three sponsors.
Yeah.
And who's the backup for the guy that I know, like, and trust, has been doing it for 10 years.
Right.
So that was a lesson learned for me that, okay, look at everybody on the team. Who's asset managing? Who's the backup to that asset manager?
Yeah.
That person isn't there.
That's a really good point. And I honestly hadn't personally thought about that. I have my own story of losing money on a deal, a different situation. A guy, he was just a bad actor. He actually committed, some a little bit of fraud. Uh,
Really?
he got in quite a bit of trouble, and but unfortunately he lost the property, and so did we in that process. So just case in point on why you need to vet the sponsor. And I definitely believe the sponsor is more important than the deal, because a good sponsor is going to pick a good deal as well. So you got to spend the time to get to know the sponsor. But the thing that you said, circling back around, you had a relationship with one of the people and that person left, and then you're still in that deal. That's where it's so important to understand, well, one, who are the other team members, and is there a team, or is it all just on kind of one person's shoulders, right? And is there a team, and who are they? But also, I think in the oh so fun reading of the operating agreements and all the details that come into it. I mean, that's where being a passive investor isn't passive, right? The work comes in at the beginning. It's doing your homework, doing your research, doing your diligence, reading all those long documents that are oh so easy just to sign and not pay attention to, right? But actually understanding, okay, what happens if somebody leaves, right? And who takes control, and how does that work? And I think those things are critical. And yeah, really vetting out the whole team and what's that structure, and are there redundancies in place? I think that's an important perspective. So to get back to the root of my question, how do you get started? And you said you got to start meeting. It really sounded like what you said was you got to start meeting sponsors, people that are
Yes.
are are out finding deals and creating these opportunities, right? So what are some of the best ways you've found to find folks like you and I?
Well, I joined a mastermind, and I've joined several masterminds, all high price masterminds. So it was the hard way to do it. And this was about 6 years ago. Now, podcasts are so huge now. If you're interested in passive investing, if you search, you go on to Apple or whatever podcast, and you look, and your name's going to come up, Kent. Your Ritter on Real Estate is going to come up. So if you're
Mhm.
interested in it, you can just Google it. Everything's Googleable now.
Yep.
So I guess that's the key, is, and then find somebody that's doing deals, lots of deals.
Yep.
And don't, not to be discouraging to newer people, but don't invest in somebody's first deal unless they've got a partner or couple partners that are really, really strong players that,
Mhm.
okay, and they've got a strong track record that they're going to be around. I mean, that's one of the things. Like, it's an unfair business, it really is, but you want to invest with somebody that's done lots of deals, that's got lots of experience, because all sorts of situations can come up that you have no control over. you
Yeah.
know, weather, we had that freeze in Texas a year and a half ago, and some of our apartments were impacted, but we had a great insurance company that took care of that. And we cover our lost rent and all those types of things, that you just don't know what's going to happen. So you really, really got to do your due diligence. So yeah, it's kind of
Yeah.
tricky. Like, that's how I got into it, is just, but now I say, Google things, listen to podcasts, find
Yep.
somebody that is on the right vibe that you like. Is this
Yeah.
person I'm vibing with? Do I like them? Do I like their
Yep.
approach? What are they saying? And really, you'll know quickly if you reach out to a lot of sponsors. You find out who's really responsive to you, who's willing to ask the dumb questions with a smile on their face. Because I was new once, I didn't know those things. Even
Right.
though I've answered that question 100 times, that's the first time they've asked it. So if the deal sponsor is not really willing to be patient with you and nurture your knowledge of this because it's not simple. It's, it's easy, but it's not simple. I
Yeah.
mean, it's easy to invest, but it's not simple. You really need to understand what you're doing. So I
Right.
guess that would be the way. Would you agree? Like, I'm asking you questions, Ken. Like,
Yeah,
wouldn't you say
no.
nowadays just Google it and then find some deal sponsors and then start reaching out to a bunch of them and find out who you like best?
Yeah,
Is that how
I
you
mean, I
do it?
think that's the right approach. Yeah, I mean, podcasts were my first intro. I mean, even so, well, it was about 5 years ago now, 5, 6 years when I started really looking at passively investing in other people's deals, but before I was doing my own. And podcasts were really how I found the first maybe 2 or 3 folks, and then, like, 2 of those folks had conferences, and so then I was listening to their podcast and then went to their conferences, and then by going to their conferences, I was able to meet a whole lot of people, right, that were doing the same thing. And so but yeah, podcasts I think are a great entry point because podcasts allow you to really get to kind of like you said, do you vibe with that person? You
Yeah.
get that feel through the podcast, right? I did when I was listening to people. I know people do because I've gotten feedback when they talk with me. And so I think that's just a really good approachable way. But yeah, you got to talk to a lot of sponsors, figure out who you vibe with, figure out who's in the markets you want to be in, right? Whose strategy aligns with yours.
Yes.
Because I think you got to, as a passive investor, you got to be solid on your own goals before you go out and look for deals because you got to know if those deals align with your goals, right? So, like you said, there's some investors out there who focus on shorter term. Maybe it's 2, 3 year deals, right? Maybe they're buying more distressed properties and it's a heavier lift, it's a higher risk, high reward, shorter turnaround type thing versus other sponsors on the other extreme that are holding for 10 years and just really buying more of something that's like a turnkey and just going to let that appreciation grow over time, right? And so what's your risk tolerance as an investor, right? What are your return expectations? Do your return expectations match your risk tolerance? Like that's one I see people they have to get aligned on, right? And I think the only way you do that is by looking at a lot of deals and you kind of understand the market, right? Like what's the market return for this kind of risk and starting to understand. But I think as a passive investor, you got to think about those things. What's my risk tolerance? What type of returns do I want? What type of hold periods do I want? Or maybe even more simple, like, is it cash flow? Is it appreciation? Is it tax savings? Like, which one of those are you really after? Because certain deals are going to provide more of that than others. And so I think starting with getting really clear on your goals and then going out and finding sponsors that match those goals.
So before when somebody contacts me that's interested in investing, the first call or meeting, we don't even talk about the deal. I want
Mhm.
to know about what you said, Kent. What are your goals are? What's your risk tolerance? What is your time frame? Do you need this money available for, like, again, to buy a house or retire or whatever? That's the most important thing. And I have turned people away and say, no, I'm not a good fit for you. This is
Yeah,
not a good fit for you. You should be looking for something, or don't invest at all because you don't have enough money, frankly. And
right.
I've said that, unfortunately. It's like, okay, you scrimp to save, 50,000, but that's your cash reserve. No, I'm not going to take your money and you shouldn't be investing that. You should keep that. So you really want to look for somebody that wants to understand what your objectives are, because not all deals fit. I mean, we do the middle of the road. I think stuff you're familiar with, the
Yeah.
value add class C plus B. So when the economy goes bad, the people in the A's move down to the B's, and when the economy is good, the people in the C's move up. So that's
Mhm.
typically what we do. We do, plan for a 6 year hold. Now, if that's not your cup of tea, that's not right. Now, I've got friends that do class A apartments. Returns not near as high, it's not near as risky. And if somebody's interested in that, I've got a friend I refer them to, because my
Yeah.
stuff's not a good fit for you. Mine are much higher margins, higher returns, a little bit more risk, and usually long, because it may take 6 or 8 months before we give a distribution because we're renovating units.
Yep.
As people leave, we update them and then we bump up the rents. Well, if you buy a cash flow in class A, it's pretty much day one, your cash flow is
Right.
never going to be as much, and the returns at the end aren't going to be as big. But if that's your needs, that's what you should invest in. So really good point. Make sure whoever you're investing with that they clearly understand. Even if you don't know, they should be asking those questions of you.
Yeah, and something else you said that sparked, something in my mind is just around like, I really think you wanna be looking to invest with a specialist. So, like you said, you do C and B class, this kind, value add, blah, blah. Other people do A. I think that when I see people that they're like, "Well, we do everything." They got some retail and some industrial and some multifamily and all this. If you've got a team where there's specialists in each of those areas, like, that's one thing, but if it's just one group who's kinda doing everything, I mean, you can't be an expert if you do everything, right? You're really looking for those specialists who go deep in one area versus kind of being generalists, I feel, because you really have to get that specialized expertise and every asset class is little bit different. So that's just another tip that you kind of sparked in my head as we're talking about this.
Yeah.
So so we've gotten to the point where, we know where to find the sponsor. How do you vet the sponsor? Because we talked about sponsor is the most important thing. How do you vet? When you started and you were passively investing, what was the process you went through to know like this is the person I want to put my money with?
I'm very I'm very vibey. Like I already brought that up. Like if I don't have a good vibe with somebody, and as a corporate guy, I've hired hundreds and hundreds of people, a pretty good track record on that. It wasn't early on, I didn't wasn't good, but after years, so you
Mhm,
can read people pretty well. And that's why I love
mhm.
the Zoom. If you can't meet them in person, Zoom. If it's somebody like you don't want to deal with for the next 6 years, don't invest with them. If you don't like my personality, not everybody, I'm not everybody's cup of tea. Hopefully, most people like me, but if you don't, that's fine because you're stuck with me for 6 years. So I'm the one that you're going to be communicating with. So I think
Yep,
that's key is like do they vibe? But then the other thing is really the track record. Past performance is the best indicator of future performance. Doesn't guarantee anything, but if
yep.
somebody's done a ton of deals and they can show you, here's the returns on my deals, you feel pretty good versus somebody that's done maybe one deal and it's in a small market or whatever. And that's the other thing is like we're big in Florida and Texas, well, in specific like Jacksonville, Florida. So my
Mhm.
partners and I, we just sold about how many units do we sell? 300 units there or whatever. We still have about 1,000 units there. So I know that market really well. So, like you said, we're a specialist in that market. My asset manager, my property manager is one of the premier res props, is one of the best property managers, and they handle all of our Florida deals. So I've got critical mass there too. They've managed, I think 15,000 units total, and I think we're maybe 2,000 of them. So we're a big player. So they take great care of us.
Yeah.
Even if we weren't big, I know they would, but so you've got those things. Take a look at the track record. Are they big players? Like I've got a friend that's doing deals in Phoenix now. I'm going to get in Phoenix deals now because he's my good friend and he's got presence there. He's got boots on the ground. We've got a great property manager. So, like you said, back to your specialization, look at their track record. Are they all over the place? Are they buying things everywhere? Do they have a team
Mhm.
in place in those cities? Because it's really important. You have, a strong property manager. It's in, it's location, location, location. It's a population growth and employment growth. So
Yep.
I would look at their past deals, see how they're doing, ask for their monthly communications they send out. Is it comprehensive or is it just, and I've invested in deals where it's an Excel spreadsheet with a couple bullet points. Well, that's not really clear. I've got to go and read through and figure out I want a summary of what it is about. So
Yeah.
get a sample of what they do for their other investors, their other deals is a really good indicator. So
Yeah.
I guess those are the tips. Take a look at the track record. How are they communicating with you? What is their key performance indicators? Are they sharing with you? Are you seeing it all? Or are they kind of hiding things, not solely transparent? So just some things you would think were obvious, but not all deal sponsors do it. So get samples so you really know what you're going to be experiencing going forward for the next 6 years.
Yeah, I mean, I think you hit on a lot there, right? You hit on communication style, transparency, presence in the market, right? I think that that's a great point. So, who are they using as managers? What's the asset management team look like? What's their presence in the market? Again, what's their expertise? Are like you said, are they all over the place? Or do they have markets they really focus on? Is there kind of a general thesis on why they're in those specific markets? Right. And all that's going to come around a track record, right? So ultimately, as you get back to it, you want to see, to me, I want to see the numbers. I want to see how you've performed on the deals you've sold, and I want to see how the deals that are currently active are performing currently, right? And it's kind of to me, the easiest way to communicate that is when you look at kind of your budget to your actual performance, and kind of understanding how they're, how they're performing. Are they over or underperforming what they've said they were going to do, right? And so I think those are all great places to dig in as you start to vet out these sponsors, right? And so okay, so we're continuing down the path. You've picked the person you want to work with. What does it look like? I mean, what should somebody expect their first time going and investing in a multifamily syndication? Like they click the button to sign up, right? And then like walk us through the rest of that process.
Okay. And this is complicated kind of. So whenever anybody, I have a new investor signs up, I'm usually on the Zoom with them and walking them through it. I remember when I started investing, the deal sponsor would send you 152 pages of the private placement memorandum. You'd print it all off and then you have to figure out where to sign. Well, now we have DocuSign. So if you say, I'm investing with cash, it's going to automatically take you to those fields. I'm investing with an IRA. So you click IRA and it'll take you to those fields. But even then, it's
Mhm.
like confusing. So I almost always walk through. If you're the first time investor, first time you've seen one of those, I'm always going to be on the phone with you because I don't want you to go through what I had to go through. So typically, that's the biggest hurdle. And then wiring funds. A lot of people have never wired funds. Now I wire funds on the daily almost. That seems like, a
Yeah.
couple times a year, a month, I'm wiring things. But if you've never wired funds, I talk them through that process. Make sure you confirm verbally, is this the right stuff? I've sent this electronically. You pulled it from the portal. Always do a verbal confirmation of the routing number and the account number and all that stuff to make sure nothing can happen in between us, you receiving that. So just little tips like that I just walk them through it because it is the first time. Now, the second time, much easier. The third time, this is cake. I know what to do. And your profiles are all set up. Well, almost all of the deal sponsors use tools that have all the documents out there in a portal. So you don't have to go and look in your emails and find it. It's all in one spot. It's all, walks you through this process. But
Mhm.
I walk every new investor through it because I just know what it was like when I had to do it myself.
Yeah, and what you mentioned a private placement memorandum. So what's included
Yes.
in that? What are people looking for?
So that's basically all the ways you can lose money. That's my I've been trained by my SEC attorney pretty heavily over the years. And it's basically there's an operating agreement there, just like any LLC has an operating agreement, like you mentioned before. Who's going to be running the asset? Who's responsible? Who's on the core team? Um, how distributions are being handled? Are they quarterly or are they monthly? How are they split out? Is it a 70-30? 70% goes to the limited partners, the passive investors, and 30% to the general partners. Now, these are things that your deal sponsor should have already highlighted before you got to that. But my
Yeah.
first few deals, I read through all 100 and some pages.
Yeah.
And I make sure, and I encourage my investors to, but I always highlight the things that if they don't read through it all, the things that you need to be aware of. So I always highlight those for them. But I would say if it's the first time, take the time. It's going to take you an hour, read through it all, write down all the questions, go back to your sponsor. What's this mean? What's this mean?
Yeah.
What's this mean? I love those investors because those are the ones that are feel really good about it, their investment because they know they've done their due diligence and
Yeah.
just didn't rely on me. I really like that. And I do encourage your first time through, do that. So I think
Yeah.
those are my big tips is read through it all and then write down the questions because you're not going to understand it all.
Yeah, I think that's great advice. I mean, and at the end of the day, you're gonna have you mentioned that operating agreement. I mean, of everything else, a lot of the documents that'll be shared are marketing documents or informational documents. It's really that operating agreement that you need to look at to make sure it ties to everything else you've heard, because that's going to be the Bible. If there's ever any discrepancy, it's going to be, what does the operating agreement say? Right. And so I think that's really important for investors to look at, especially, what are the terms, right? What are the preferred returns? What are the splits? How are people getting paid? What are the fees? Right. I think those things are really critical. And no matter what you were told or what it said somewhere else, whatever is in that operating agreement is what is going to govern at the end of the day. So that's really important, I think, for folks to know.
That's the law. That's what it's going to go back to. That's what the
Yep.
legal description is. That's the key
Yep.
thing. So good point.
Yeah.
Yes.
Well, that's awesome. And so then, so we get through all this paperwork, right? You get all your questions, you get all of them answered, you get all the paperwork signed. You wire your funds in, which is not difficult, but can be intimidating the first time
Mhm.
you do it. I totally recognize that. Um, and then what? What happens from
And
there?
and then just look for communications from your deal sponsor, your general partners. And it should be I don't know anybody that does less than monthly. Do you? I mean, does anybody doing quarterly updates? I'm not
We do
investing in any deals. Do you guys?
we do monthly.
You do okay. Like, okay, me personally, again, I'm a little bit of a control freak, but I passively invest in tons and tons of deals. But I want to see monthly communications. I want to know what's
Mhm.
going on a month to month because once a quarter, things could go crazy and I don't know about it.
Yeah.
And so in the transparency, like, trying to think of examples, a fire occurs in one of the units or whatever. You include that in there, and then you give a status of, okay, this has occurred. We filed it. We're gonna have one unit out or whatever. And then next month you can look to see, okay, has it been resolved? And
Mhm.
find out how that. But it's really good monthly communications, and really that's it. And ask questions. I love questions. I love the fact that somebody took the time to read through it all to say, oh, you know what? And sometimes we'll let our investors vote on colors and things like that. Like well, or
Oh,
naming
really?
things or what. Yeah, we used to do this. I haven't done it recently, but we used to do like, okay, what are we going to name the dog park or whatever? Just fun stuff to get engagement on that.
Yeah,
Or
that is
signs.
fun.
Oh, when we did our signs a few years ago, like we'd say, here's the 3 signs that we picked. $1,000. We had the investors vote, and there's like 72 investors. So they voted. So whoever had the most, that's the sign we picked. So we do fun stuff like that, just to make it, because you want to deal with somebody that's enjoyable to work with. So it's
Right.
not just an Excel spreadsheet with all the financials. Well, I want somebody to interpret that for me. Like you said, what are the expense ratios? How are they doing? Are we over or under budget? What's our occupancy? What are
Mhm.
we doing if our occupancy went down? What actions are we taking to make sure that those get back up? Are we offering some incentive, or was there just something that went on, that we didn't know about? Maybe there was a block of 4 apartments that were rented by one company or something like that. That will occasionally occur. Like all of a sudden, I've got 10 occupied apartments. Why
Mhm.
is that? And somebody sees that. Well, if you can explain, oh, this is okay, this is fine. We knew this was going to happen. We're on it. So I
Yeah.
think then that's the fun part is just, and I open up I'm invested in tons and tons of deals every month. I click, take a look at and most of them give me summaries. Some of them don't. I'm not happy with those people. I just take a quick look at it, browse through, say, okay, what's it looking? Is the net operating income? I love graphs. Is it
Yep.
going up, going down, and things like that. So that's the fun part, and just make sure you're looking at those. I mean, it's your investment, it's your money,
Yeah.
and ask questions. So yeah, it's pretty easy after that. That's the fun stuff.
Yeah. Yeah. We've gotten through all the stuff, the tough part.
Yes.
Well, I mean, Matt, I think this is really helpful. I hope for folks. I think we've walked through all the steps. I think this is a play by play on how to get into your first investment, right, and how to approach it. So I appreciate you sharing your own perspective for both being a passive investor and now running deals. I think that's really good insight. As we wrap things up today, I want to take you through our keys to success round. There's 4 questions I want to ask you. The first one is this is right up your alley. If you were going to invest your money in somebody else's deal and you could only ask them one question, what would that one question be?
Track record, just that simple. And then they
Yeah.
should be able to demonstrate, hey, here's the last 3 deals we closed. Here's our returns. Just that simple.
Yep. Yeah. Just as easy as that. What are you most proud of in your career?
I would say early on, I had 5 properties under contract with some partners. This was a couple of years ago. We had 5 deals going on at one time. Never, never, never do that. But
Yeah,
we
that's a
we have
lot.
managed to close them all, to keep them all straight, because I'm dealing with the property manager, the lender, the insurance, and the attorneys, and all that. And so it was really key in the subject line, which property I'm talking about, because they're dealing with me on 5 different properties. So
Yep.
that was, I think, the big, and never ever do that again. Right now, I'm general partner in 2 deals, but I'm not doing it, the heavy lifting. My partners are. But that, I think that was a big accomplishment, to do 5 deals at one time. Again, never do it again.
Yeah.
But I was the herder of cats. I had an Excel spreadsheet, who's doing what on what dates, what's the timeline for all 5 projects. And every morning we would review those so everybody knew what their tasks were to get it closed. So I think that
Yeah.
was probably my biggest accomplishment. I don't recommend doing it. Don't do
That's
it.
a heck of an accomplishment. I know from, I mean, just doing 2 deals at a time that, I mean, 5 would be quite the, hurdle to climb. So congratulations on getting
Thank
those
you.
done. What is the book that everybody should read?
Okay, and see, I'm a fan of the show, so I was prepared.
I
Viktor
appreciate
Frankl's
that.
the Meaning, Man's Search for Meaning, and it really is. It's a heavy read. It's a psychologist that was in the Nazi concentration camps, and it's all about your perspective on life, and that it's not all about what you own and things like that. It's your meaning. What's your purpose in life?
Mhm.
So here's an example. So my wife retired about 2 years ago, and she's driving her crazy. She needs more purpose. So she's actually looking for a job now because, like, okay, her purpose was she worked for nonprofits. She did the marketing. She did great things for the world while I
Yeah.
worked for a chemical company. So there's the yin and yang there. But she's like, I've realized, this the last few months, she's, you know what, I just got it. And she helps me with the business and stuff because purpose, meaning. So I think that's a really good book for anyone to read. It's a little heavy, but it puts things in perspective. So I try to read it like once a year or so, and it'll make you cry a little bit if you have a heart, but it really does put things in perspective. I mean,
Yeah.
you have to have some purpose in life.
No, I love that. I mean, I think if, your purpose, if you have a strong purpose, you can accomplish anything, right? I think that's what pushes you through. I think like purpose over fear or whatever the quote is you want to say, like those are the things that'll get you beyond all those limiting beliefs and all the stuff you have in your head.
Yes.
If your purpose is greater than that, you can accomplish great things and it'll push you out of your comfort zone and get you to do all kinds of things you didn't think you could do. And that's coming from my own personal experience. Well, very good. Last but not least, um, last but not least is what is your number one key to success?
I think it's just my devastatingly good looks, Kent. I think that's it.
I think you nailed it.
No, no, okay. Actually, the same my dad used to say when we were kids, you need to be persistent and consistent to accomplish anything in life. And I didn't know what that meant at all as a kid, but as an
Mhm.
adult, I really lived it. That was my mantra. Persistent and consistent. You got to keep doing it. You got to keep doing it. So
Yeah.
those are the words I live by, given to me by my dad years ago.
I think that's fantastic advice. I mean, I think that's as I've done a lot of these shows now, I mean, there's just a common theme around consistency and just showing up and just
Yeah.
continuing to keep at it. And I think that really is the key to success.
Mhm.
Well, Matt, I appreciate you coming on the show today. I appreciate you sharing your knowledge with us. I appreciate you giving us your insights into how to be a great passive investor and how to go about finding a sponsor and hopefully making it more approachable for people. As we said, live in the mission to get more people into real estate investments. So again, thank you so much for your knowledge. And if folks want to learn more about you, about Hanson Holdings and what you're doing, how can they get a hold of you?
Just go to hansonholdings.com. And we've got all sorts of information. We've got a free download there, Rethink Your Retirement, just a 9-minute read. And it's really for those people that were schmucks like me that had all their money in the retirement accounts. Is that
Yeah.
take some of that money, match your 401k, but beyond that, put it in something else that you have access to, that you can do other things, invest outside of Wall Street. Because that your 401k and IRAs don't allow you to do the things that you and I are doing to 10x our wealth. And that's my mission. So
Yep.
hansonholdings.com, and Kent will have it in the show notes.
That's right.
There's lots of resources there. And reach out to me if you're interested in learning more. I'm happy to talk to you and see if it's a good fit for you. And it's not a good fit for everyone, but if you're in the position, educate, listen to this show.
Awesome. Well, thank you, Matt. It's always a pleasure. Appreciate you coming on, and I hope you have a great rest of the day.
Thanks so much. Take care.